You clicked because you want to know how much of your paycheck belongs in savings every single month. The truth is that the standard advice telling everyone to save exactly 20% is often mathematically wrong for your specific situation and can actually be holding your financial growth back. By the end of this video, I will show you a dynamic life stage method that calculates your exact number based on your debts and goals, rather than forcing you into an arbitrary percentage that might be too low or dangerously high. Most people start their money journey with one simple rule: save 20% of every paycheck no matter what happens. This advice is comforting because it gives you a clear target, but it ignores the messy reality of personal finance where your life changes constantly and so do your financial needs. When you have high-interest debt, that rigid number becomes counterproductive because paying off expensive loans offers an instant guaranteed return on investment that beating market returns rarely can match during those early years. Think about a junior engineer earning $30,000 who also carries $5,000 in credit card debt at 24% interest. If they follow the standard rule and save $600 while only making minimum payments, they are effectively paying their bank 48% return on that money through fees and compounding interest every single month. The opportunity cost of ignoring this gap is massive because you are letting wealth evaporate faster than it can accumulate in a savings account earning barely 1 or 2% annually. Research from open-source financial tools hosted on GitHub reveals that required savings rates are strictly algorithmic functions of your target cost, the time horizon you have to reach it, and your current assets. A tool called the Goal-Based Investment Planner demonstrates that inflation-adjusted future costs often demand monthly contributions far exceeding 20% for major life events like marriage or funding a child's education if those goals do not happen immediately. Conversely, someone nearing retirement with substantial existing assets might find that saving another fixed percentage is excessive and unnecessary when their portfolio already generates enough income to cover living expenses. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. The problem deepens because variable interest rates and fluctuating incomes are essential for any true strategy, yet most scripts fail to account for them in a meaningful way. A dynamic life stage savings rate shifts your mindset from maximizing savings to optimizing the return on capital you have available right now. This means that during debt elimination phases, your highest leverage action is often upskilling or paying down high-interest balances rather than strictly adhering to a savings percentage that delays these critical financial repairs. Consider how real-world data shows a savings rate of 18.9% is achievable and often more sustainable than rigid targets like the 50-30-20 rule suggests. This finding implies that flexible allocation between 15 and 20% adapts better to variable income streams and housing costs, rather than relying on a binary cutoff that forces you into lifestyle inflation or financial stress when your paycheck shrinks unexpectedly. The 3-paycheck month logic found in modern budgeting scripts highlights how engineers often oversave during high cash flow months while undersaving during lean periods, creating an unstable contribution curve that jeopardizes long-term consistency. A dynamic rate tied to net cash flow after debt repayment smooths this curve and prevents the boom and bust cycle of savings behavior that leaves people feeling anxious about their financial security every single month. When you calculate your necessary contributions based on the gap between where you are now and where you need to be, a junior engineer with a modest target might only need 5%, while a senior professional aiming for early retirement could require 40% or more depending on inflation rates over the coming decades. This proves that a universal 20% rule is an architectural flaw in personal finance because it treats every individual as if they have identical goals and timelines, which simply does not exist in reality. However, there is a critical limitation to this approach you must understand before applying it. While evidence strongly supports abandoning rigid percentages in favor of goal-driven calculations, the synthesis lacks empirical data on how users actually adjust their savings rates when facing real-world income volatility or psychological barriers during aggressive debt elimination phases. Consequently, your dynamic rate requires active, ongoing recalibration rather than a one-time calculation that you set and forget for years at a time. You must treat this as a living strategy where you review the numbers every quarter to account for new debts, salary increases, or changes in inflation expectations. The psychological feasibility of aggressive savings rates is often overlooked by algorithmic tools because they calculate mathematical necessity but do not measure your mental bandwidth or capacity for sacrifice during difficult months. If you push yourself too hard with a 40% target while still paying off loans, the likelihood of burning out and quitting entirely increases significantly compared to a more gradual approach that prioritizes behavioral consistency over theoretical optimization. The goal is to find the sweet spot where you are saving enough to make progress without sacrificing your quality of life so much that you abandon the plan altogether. This shift from maximizing savings to optimizing return on capital changes how you view every dollar in your budget because it forces you to ask what each dollar can do for you right now, rather than just assuming a fixed percentage is always best. For someone with high-interest debt, that optimal action might be paying down $10,000 of credit card balance instead of putting $500 into an index fund where the gains will take years to outpace the interest charges they are incurring daily. The highest return in your early career stage is often investing in upskilling or eliminating expensive liabilities rather than strictly adhering to a savings percentage that delays these high-leverage actions and keeps you stuck in place financially. By adopting this life stage approach, you stop fighting against arbitrary numbers and start building a financial plan that adapts to the unique variables of your own life story. You will no longer feel guilty for saving less than 20% when debt elimination is the priority. Nor will you stress about missing out on growth opportunities if your math shows you are already ahead of schedule due to strong asset accumulation or high income relative to goals. The correct rate is a function of the gap between your current net worth and your target, meaning it evolves as you evolve rather than remaining static for decades regardless of circumstances. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.